SVOL, the ETF that profits from volatility. Hey everyone, and welcome back to Chat ETF. Today, we're diving into the Simplify Volatility Premium ETF, also known as SVOL. Now, this ETF has been gaining some traction, but is it actually a good investment for you? Before you jump in, there's a lot to unpack. We'll break down how SVOL works, the potential benefits it offers like income generation and downside protection. But remember, every investment has risks, and SVOL is no exception. We'll explore the different risks involved, like market volatility and option strategies. Plus, we'll discuss who SVOL might be suitable for and who should probably stay away. So, stick around as we answer the question, should you invest in SVOL? Don't forget to subscribe for more in-depth ETF analysis, and hit that notification bell so you never miss an upload. Question 1. What is the SVOL ETF? The Simplify Volatility Premium ETF, SVOL, is an actively managed exchange-traded fund designed to capture the volatility premium. This premium refers to the historical tendency for markets to offer higher returns to investors who hold assets with greater volatility. Question 2. How does SVOL achieve its objective? The Simplify Volatility Premium ETF, SVOL, aims to capture the volatility premium by employing a two-pronged approach utilizing option strategies. 1. Selling cash-secured puts. Mechanism: SVOL acts as a put seller on the S&P 500 index, SPX. This involves selling put options, contracts granting the buyer the right, but not the obligation, to sell the underlying asset, SPX, at a predetermined strike price, by a specific expiration date. Income generation: by selling puts, SVOL collects a premium upfront regardless of whether the option is exercised. This premium income contributes to the fund's overall return, offering a potential source of consistent income. Downside protection: if the SPX price falls below the strike price, the put option becomes profitable for the buyer, incentivizing them to exercise the option and sell the SPX to SVOL at the strike price. While this obligates SVOL to purchase the SPX, it can potentially mitigate losses compared to directly holding the index, as the predetermined strike price acts as a buffer against significant price declines. 2. Collateralized call overwriting. Mechanism: SVOL also engages in call overwriting, which involves selling call options on individual stocks within the S&P 500 index. Call options grant the buyer the right, but not the obligation, to buy the underlying stock at a specific strike price by the expiration date. Upside potential: similar to selling puts, SVOL collects a premium upfront for selling call options. This additional income stream contributes to the fund's return. However, unlike put selling, call overwriting has a limited upside potential. Capping gains: if the stock price rises above the strike price by the expiration date, and the call option is exercised, SVOL is obligated to sell the underlying stock at the predetermined strike price in exchange for the premium. While this generates income, SVOL misses out on any potential further appreciation in the stock price beyond the strike price. Combined effect: by strategically combining these two option strategies, SVOL aims to 1. Generate income: The premiums collected from both put and call options contribute to the fund's total return, offering a potential source of regular income. 2. Offer potential downside protection. The put selling strategy can provide a buffer against significant market downturns, as SVOL is obligated to buy the SPX at a predetermined price, potentially mitigating losses compared to directly holding the index. 3. Benefit from moderate market volatility. When the market experiences moderate ups and downs, SVOL can potentially benefit from both the premiums collected and the limited upside potential from call options. Question 3. What are the key characteristics of SVOL? The Simplify Volatility Premium ETF, SVOL, carves its own niche within the vast landscape of exchange-traded funds, ETFs, by deviating from the traditional, passively managed approach. Here's a deeper dive into its defining characteristics. Investment objective. Harnessing the volatility premium. SVOL's primary focus lies in capturing the volatility premium. This well-established market phenomenon suggests that historically, assets exhibiting higher levels of volatility have tended to offer investors potentially higher returns. By employing specific strategies, SVOL aims to capitalize on this historical relationship. Strategies. Active management. Unlike its passively managed counterparts that simply mirror an underlying index, SVOL takes an active management approach. This means the fund's success hinges on the expertise and decision-making capabilities of the fund manager responsible for selecting and implementing options trades within the fund's strategy. Option-based approach. The cornerstone of SVOL's strategy lies in its option-based approach. The fund strategically utilizes two distinct option strategies. 1. Selling cash-secured puts. This strategy involves SVOL acting as a put seller on the SP 500 index, SPX. In essence, SVOL sells put options that grant the buyer the right, but not the obligation, to sell the underlying SPX shares at a predetermined strike price by a specific expiration date. By selling these put options, SVOL collects a premium upfront, regardless of whether the option is ultimately exercised. This premium contributes to the fund's overall return and offers a potential source of consistent income. Additionally, if the SPX price falls below the strike price, the put option becomes profitable for the buyer, incentivizing them to exercise the option and sell the SPX shares to SVOL at the predetermined strike price. While this obligates SVOL to purchase the SPX shares, it can potentially mitigate losses compared to directly holding the index, as the predetermined strike price acts as a buffer against significant price declines. 2. Collateralized call overwriting. This strategy involves SVOL engaging in call overwriting, primarily focused on individual stocks within the SP 500 index. Here, SVOL acts as a call seller, selling call options on these selected stocks. Call options grant the buyer the right, but not the obligation, to buy the underlying stock at a specific strike price by the expiration date. Similar to selling puts, SVOL collects a premium upfront for selling these call options. However, unlike put selling, call overwriting has a limited upside potential. This is because if the stock price rises above the strike price by the expiration date, and the call option is exercised, SVOL is obligated to sell the underlying stock at the predetermined strike price in exchange for the premium collected earlier. While this generates income for the fund, SVOL misses out on any potential further appreciation in the stock price beyond the strike price. Distributions here. Monthly distributions. Unlike many traditional ETFs that might distribute dividends quarterly or annually, SVOL aims to distribute dividends monthly. This can be particularly attractive for income-seeking investors, as it offers a potential source of regular income. Question 4. How does SVOL's option selection methodology impact its performance? SVOL's option selection methodology plays a critical role in its performance, influencing both the potential rewards and the associated risks. Here's a breakdown of the key aspects here. 1. Strike price selection here. Impact on income generation. The strike price chosen for selling puts and calls directly affects the premium received by SVOL. Selecting a higher strike price generally results in a larger premium upfront. However, this also increases the likelihood of the option not being exercised, potentially limiting the total income generated from the strategy. Conversely, choosing a lower strike price might lead to a smaller premium, but increases the possibility of the option being exercised, potentially leading to higher income if the market moves in a specific direction. Impact on potential downside protection. In the case of put selling, the strike price determines the break-even point for SVOL. If the SPX price falls below the strike price, SVOL will be obligated to purchase the index at the strike price, potentially incurring a loss. Therefore, selecting a higher strike price provides a greater buffer against significant market downturns, while a lower strike price offers less protection, but potentially higher income generation when exercised. Impact on potential upside. For call overwriting, the strike price influences the potential upside SVOL can capture from a stock's price appreciation. Selecting a higher strike price allows SVOL to benefit from larger price increases before the call option is exercised, but it also limits the premium received upfront. Conversely, choosing a lower strike price offers a higher premium, but caps the potential upside if the stock price rises significantly. 2. Expiration date selection. Impact on income generation. The expiration date of the options chosen by SVOL affects the time value of the premium received. Options with longer expiration dates typically have a higher premium compared to those with shorter durations. However, longer expirations also expose SVOL to greater market volatility over a longer period, potentially leading to larger losses if the market moves against their positions. Impact on flexibility. Shorter expiration dates offer greater flexibility for SVOL to adjust its option positions based on changing market conditions. However, they may also result in lower premium income compared to longer-dated options. 3. Underlying asset selection. Impact on risk profile. The specific stocks chosen for call overwriting within the SP 500 index can influence the overall risk profile of the fund. Selecting volatile stocks can potentially generate higher premiums, but also increases the risk of losses if the stock price experiences significant declines. Conversely, choosing less volatile stocks might lead to lower premiums, but also offers a more conservative approach. 4. Portfolio weighting. Balancing income and risk. SVOL needs to balance the allocation of its capital between selling puts and call overwriting to achieve its desired risk-return profile. A higher allocation to put selling generally generates more consistent income, but also exposes SVOL to greater downside risk. Conversely, a higher allocation to call overwriting offers limited upside potential, but also carries lower risk compared to put selling. It's crucial to understand that SVOL's fund manager plays a vital role in making these critical decisions regarding option selection. The chosen methodology and specific parameters significantly influence the fund's performance by impacting the income generation, potential downside protection, and overall risk profile. Question 5. How does SVOL manage the roll date risk associated with its option strategies? Roll date risk arises in SVOL's option strategies due to the inherent nature of options contracts. These contracts have specific expiration dates, and as they approach expiration, SVOL needs to address this risk to maintain its desired exposure to volatility. Here's how SVOL manages roll date risk. 1. Monitoring and proactive management. SVOL's fund manager actively monitors the remaining time to expiration for its option positions. This allows them to proactively manage the roll date risk by closing out existing positions and opening new ones with further out expiration dates before the current options expire. 2. Considering multiple factors. The decision to roll options involves careful consideration of several factors, including current market conditions, the prevailing market environment, such as volatility levels and prevailing trends, can influence the decision to roll. For example, in a highly volatile market, SVOL might choose to roll options to capture potential higher premiums associated with shorter-dated options. Remaining time to expiration. As the expiration date approaches, the time value of the option diminishes, making it potentially less beneficial to hold onto the expiring contract. Cost of rolling. Rolling options involves transaction costs associated with closing out existing positions and opening new ones. SVOL needs to weigh the potential benefits of capturing continued volatility exposure against the costs incurred through rolling. 3. Rolling strategies. SVOL can employ various rolling strategies to manage roll date risk, such as standard roll. This involves simply closing out the expiring option and opening a new one with the same strike price and underlying asset, but with a further out expiration date. Calendar spread roll. This strategy involves simultaneously closing out the expiring option and opening two new options with different expiration dates, but the same strike price and underlying asset. This allows SVOL to adjust the time value exposure while potentially maintaining the desired delta, a measure of the option's price sensitivity to changes in the underlying asset price. Butterfly spread roll. This more complex strategy involves a combination of buying and selling options with different strike prices and expiration dates. This allows for more targeted adjustments to the risk-return profile while managing roll date risk. 4. Potential impacts. While roll date management is crucial, it's important to acknowledge its potential impacts. 1. Transaction costs. Rolling options incurs transaction fees, which can eat into SVOL's returns if done too frequently. 2. Imperfect roll. Rolling options might not perfectly replicate the original position's risk-return profile due to changes in the Greeks, measures of option price sensitivity to various factors, and market conditions. 3. Missed opportunities. Early rolling might cause SVOL to miss out on potential profits if the expiring option experiences favorable price movements before expiration. Question 6. What are the potential benefits of investing in SVOL? The Simplify Volatility Premium ETF, SVOL, offers several potential benefits for certain types of investors, but it's crucial to remember that these benefits come with inherent risks. Here's an overview of the potential advantages here. 1. Income generation. SVOL's primary strategy of selling cash-secured puts and engaging in call overwriting aims to generate consistent income through option premiums. These premiums are collected upfront, regardless of whether the options are ultimately exercised. This can be particularly attractive for income-seeking investors, such as retirees or individuals relying on regular investment income. 2. Downside protection. The put-selling component of SVOL's strategy can offer some level of downside protection during market downturns. If the market falls, SVOL is obligated to buy the underlying asset, SP 500, at a predetermined strike price. While this might result in a loss compared to holding cash, the predetermined strike price acts as a buffer against more significant declines compared to directly holding the index. 3. Potential for enhanced returns. The combined option strategies employed by SVOL aim to potentially enhance returns compared to a traditional buy-and-hold approach, particularly in volatile markets. By capturing the volatility premium, SVOL can potentially generate returns even when the underlying market experiences limited or negative movement. 4. Diversification. SVOL's low correlation with traditional asset classes like stocks and bonds can contribute to portfolio diversification. This means that SVOL might not move in tandem with the broader market, potentially offering a hedging effect and mitigating overall portfolio risk. 5. Access to option strategies. SVOL provides indirect access to option strategies for investors who might not have the expertise or risk tolerance to directly engage in options trading. This allows them to potentially benefit from the potential advantages of options, while avoiding the complexities of managing individual option positions.